Hi guys, and welcome to the February edition of the Zoopla report. Now, for those of you that haven't watched this before, this is where we go into depth in the latest Zoopla report. We look at the numbers, we look at everything behind the numbers as well, not just in terms of the surface, but what's fueling those numbers, buyer demand, and of course where we think things are going to go over the next month to 2 months or so. So, of course, if you want more of this, like, subscribe, hit those buttons now, and of course you'll be regularly updated with everything we do. So look, without further ado, let's jump in. So as you can see, the headlines are 6.5% growth year on year. So still positive, even though month to month we are dipping over the last few months. But if we take year on year, there is still an actual increase in the price. You've got 10% increase in home buyer demand, which is above 2019 levels. And of course, we've got a 27% of buyers are actually looking for 1 to 2 bed flats. Now that's really key. We've been through this in previous reports. We're going to come onto this in a bit more depth a little bit later on. But bear that in mind when you're looking for properties, because we predominantly deal with investments. But when you're looking for investment properties, bear that in mind. So in terms of the executive summary here, you can see the house price growth is pretty much ground to a standstill. Q4 was pretty sluggish. We sold a lot of properties in Q4, but in terms of the actual prices, they didn't move too much at all. In fact, what we saw is October and November, we saw a lot of offers coming in for the investment properties that we deal with, and we had a lot of developers accept those offers, which was great for our investors because it meant that they got the same property for cheaper than they would have done 2-3 months before. Most regions, now not all, but most regions registered small house price falls in Q4, the last 3 months of the year. But we've still got demand 10% higher than where it was in 2019. It's in line with 2018, but as I say, 10% higher than 2019. So strip out those sort of crazy COVID 2 years where no one knew, no one had that crystal ball with what was going to be happening. But the reality is that it shot up over the last couple of years. But the reality is we're back now to where we were in 2018 and 2019. This is key as well. The last point here, demand that is expected to improve further, especially in the coming months as mortgage rates continue to fall, which we have seen, of course, and would-be movers realise that the large house price falls are unlikely to materialise. Now that's key because so many comments we get from investors, so many comments we get from residential buyers, and of course people that just comment on these videos that are saying, well, there's going to be a crash. We're waiting for this crash. But what if it doesn't happen? What if it doesn't materialise? The reality is most people think that the crash won't materialise. They, of course, think a correction is going to be there. There's going to be a few percent here and there. But this 25-30% crash that people are waiting for, it looks like they're going to be waiting for a long time, and it's just simply not going to happen. So what we say to people is if you are waiting for that, speak to a lot of brokers, not just with us, but with other agents, and get the consensus around the industry, because the consensus is that actually that those falls aren't going to be forthcoming. If we started to see interest rates up to 7-8%, which is beyond where the majority of mortgages have been stress tested, then of course that's a totally different scenario. But we're now seeing rates at 4%, and there's expected to be potentially another hike next month up to 4.5%. But the reality is that we're starting to see inflation come back down, and of course inflation comes back down to a normal level, then we'll start to see interest rates come back down, and then of course mortgages fall as well. So that's the key here. But again, we're going to come back to this in a bit more detail a bit later on in the video. So as we head back to the report, we can see here that the momentum in the house price in 2020, 21 and 22, it fell and it really stalled in the last 3 months of the year. We're still waiting for the exact numbers to come out. There's a couple of different consensuses on what happened in Jan. We had Rightmove saying that actually things were ticking up, but we had Halifax saying that things were coming slightly down. But again, it was pretty static in January as well. But the reality is house prices did stall in the last 3 months of the year. There's no getting around it. But the reality is they weren't that dramatic. Okay, so if we look at the chart here, we can see Northern Ireland had the most of the fall, and of course London as well. It bore a lot of the brunt. But as we head to the left of the chart, if we head to Wales again, we saw that the Wales was still increasing, As we head to the East Midlands, again, slight increase there, nothing major. And typically the Northwest, which is where we're looking at, the Manchesters, the Liverpools, again, very, very slight decrease, but again, nothing major. And in terms of the West Midlands, again, and all across those areas, like the Birminghams, Bristols, all those kind of places, again, the reality is there are slight increases there. But where is demand? Because that's key. If you've got no demand, forget it. The house prices will keep tumbling until the demand starts to kick in. But demand for homes has actually rebounded for the first few weeks of 2023, which you can see. It remains well below the levels of 2020 to 2022, which is understandable because they were well over the top. They were, particularly, accentuated simply due to COVID and what people were looking at. But the reality is if we go back to the normal years of 2017, 18, 19, the current buyer demand is in line with those years, and actually, as we said before, 10% ahead of where it was in 2019. And like we said here, it's not surprising. The last 3 years have been exceptional, and it's not the norm. We have to look at that. We have to take it into context. If people are expecting that year in, year out, it's just not going to happen. So take it into context. The reality is the last 3 years haven't been normal, but against normal kind of figures, we are there or thereabouts. So as we head to 2023, what's expected? Well, we've actually said before, 2023 for us is going to be a solid year. It's not going to, set records. We're not going to be sitting here at the end of the year saying, well, we've had another 10, 15% growth. We certainly don't expect that at all. But we certainly don't expect a 10 to 15% dip either. We think that there's going to be a slight correction continuing from the last 3 months of 2022. We think there's going to be a slight correction, January, February and March. But we actually think spring, summer are going to bring around some, nice bargains for clients. But also the demand we're now starting to see is increasing again as people realise that, this is where mortgages are. Mortgage rates aren't going to suddenly rocket up and aren't going to suddenly decrease rapidly. This is where they are. People start to, sense a normalisation in terms of the mortgage rates, and they start to sort of think about what they need to save and what they need to put in. And reality is what's their outgoings going to be, and then they'll start to buy. So we think that demand is going to start to increase, especially to the second half of this year. And we think that we're going to come out probably actually 2 to 3% of an increase on the year, rather than all the sort of crashes that people are starting to predict last year. And now what we start to hear is a lot less of that now, especially as mortgage rates start to settle. So we think that we're probably going to have a pretty solid 2023 as well. Back to the report, as I say, the start of the year is going to be a slow burn. Prices start to fall away quickly, as we said here in Q1. And again, we've got mortgage rates here for new business generally below 5%, and looks set to range between 4 to 5% range for 2023. Now, of course, we're nowhere near the levels that we had of the 1.89s and up to 2.5 for residentials and 2 to 3s for buy-to-lets, but it's much better than what was predicted. Back when we had the mini budget in September and October, people were looking at 6 to 6.5, even 7% mortgage rates. That's what put a lot of people off from buying. But we're now sitting 4.5%, 5% mark, and again, that's a lot more normal. We're not too dissimilar to where we were in the 2000s, mid 2000s. But again, we don't have the liquidity crisis that we had in 2008. So we're starting to see the outlook becomes clearer after Easter. This is just basically replicating what we're saying. We do believe that after Easter and after the first quarter is over with this year, we start to see demand pick up. We normally see that anyway as the weather gets a bit warmer. Ironically, we've got a lovely day behind us in London today, but the reality is we don't normally see it this time of year. It's normally grey skies. But as spring starts to pick up, we start to see more and more people go out, venture out, and start to look for those properties. Now, this chart's pretty key as well. So if you can sort of have a look in here, you can see the grey line at the bottom was 2018. The black line, which spiked and then sort of has fallen off quite quickly for the last 3 months. We're now tracking the same as sort of 2018, but we're slightly ticking up for 2019. So the black line was 2022, and you can see here where we are right at the start for 2023 in January. As I say, we're in line with where we were a couple of years ago, which were the normal years. Supply as well, that's key. Something that restricted things during COVID was a lack of supply. Now, why was there a lack of supply? Well, people downed tools for a couple of reasons. First of all, they downed tools because they didn't know what was going on, whether they could build or not. They downed tools because materials were unbelievably hard to come by. And last but not least, they got really expensive as well. Wood shot up by 60 to 80%. So you started to have developers that were making a good profit, they were going to start to make a loss, so they just simply didn't build. That cut supply, and again that put pressure. Basic, economics rule 101 is basic supply and demand. The reality is, if there's a restriction on supply and demand remains constant, then it's going to push the prices up, and that's what we saw. But as you can see here back in the report, we're starting to see the fact that supply is starting to increase again. Now, average agent, so again, we are not an estate agent, as I say, we're more of an investment brokerage, but in regards to what your average estate agent has per agency, they had 14 homes in early 2022. That's it. They only had 14 homes on their books. They were struggling to make money. But the reality is they're now up to 23 homes per estate agent, and that's a much more positive proposition to what it was this time a year ago. So supply boost, choice for would-be buyers, and of course it reduces that pressure on the price, which is, as I say, just basic economics. So what are we seeing with flats? Now, if you look at some of our videos and our webinars from what we did 2 years ago, we always said don't follow short-term fashion trends. And the short-term fashion trend at the time was this need for space. We knew that it wasn't going to last, because the reality is that COVID was only ever going to be something that was going to be short-term. There had to be a solution to it in the end. Otherwise, we probably wouldn't be set up today, and people wouldn't be worried about money at all. There had to be an end to it. So the reality is this short-term need for space dissipated, and people went back to the normality. And the norm is people want jobs. People want to be around the jobs. Young people want to be close to bars, city centres. So we knew it was going to come back. So actually, people that took advantage of that and bought in the city centres, we had clients buying up, one beds in the heart of Manchester at 160. They're now easily worth, 230, 240. And that was only over the last sort of couple of years or so. So the reality is we knew it was going to come back. And it just says it here. If you look at the report, you can see the clear trend from the first few weeks of 2023 is they're looking more value conscious in response to buying power and higher mortgage rates. And there's a clear shift in demand towards flats, with a decline in buyers looking for 3-bed houses. Again, it's not just something that we're saying, oh, look what we said and we can't prove it. If you look back at our videos and our webinars 2 years ago, we said exactly the same thing. We said, don't shift away from flats, because this is where things are going to happen over the next couple of years. 27% of new buyers are looking for 1- and 2-bed flats, up from a year ago. Demand for 3-bed houses has fallen 5% to 39%, although they're still the most in demand. They're not the most in demand for rent, and that's what we look at from an investment perspective. What are our landlords going to benefit most from? Buying a 3-bed house or buying a 1-bed flat? 100% is buying a 1-bed flat, because that's what renters are looking at. Why? Well, because they're city centres. 2, because they're close to everything. They're close to jobs, bars, restaurants, cafes, friends, family. But importantly as well, it's cheaper to run. It's far cheaper to run, because of course we've got to look at energy costs as well. It's far cheaper to run a 1-bed than it is a 2-bed or a 3-bed or a house, and so on. So that's why a lot of people are now looking to rent those 1-bed flats, and they're proving unbelievably popular. We had a recent development ourselves that completed, and 12 months ago we put potential rent on there of 850, and they've started to rent out for 1,100. So we didn't think we were overly conservative, but it turns out that we've been really conservative, and they're renting out for far more, 20-25% more than what we originally anticipated. So we can see the interests in flats growing, and that's where we would stick to as well. And again, it's got here, flats have been not just city centres, but also outside of city centres in commutable towns, whether that's close to London, Slough, Watford, Chelmsford, Guildford and Dartford. And of course in the north, places like Stockport, Wakefield near Leeds. So those kind of areas as well. But as I say, 100% if you're an investor and you're looking to invest, we would say city centres, flats are the way to go. So as I say, the outlook, we've said the outlook from our perspective, 100%. We think 2023 is still going to be a solid year, even if it remains flat. Do you know what? Even if it dipped, even if the market dipped by 5%, it's still better to get into something now. Why? It's because you can bid developers down. Developers will react to bad news just like investors will. A lot of investors make the mistake of putting things on hold if there's bad news in the paper. But what they don't realise is that developers are reading the same papers that you are. They're reading the same news reports that you are. So go to a developer and bid them down by 5%, bid them down by 10%, see what you get. If you get a bargain, then if it does fall 5%, well, you've mitigated that because you've got a discount. And if it doesn't fall 5% and it actually goes up 2 or 3%, well, you've got an absolute bargain. And on top of that, you've made between 5 to 10% income. As I said, on the traditional ASTs, that's a 12-month tenancy. We've got some that are returning 7 to 8% at the moment. And on a short-term let, they are doing 10 to 12% quite comfortably. So the reality is there's some great deals to be had, even if the market is a little bit static. So as we head back to the report, we can see here what cities are improving as well. And you can see here in terms of the cities, it's pretty much the same. You've got Nottingham at the top. There's some areas close to Nottingham as well that are doing phenomenally well, but Nottingham 9.1%, Manchester, Birmingham, Leicester, Liverpool, Cardiff, Leeds, all those areas, Sheffield in 9th there as well, making up the top 10. And of course, as we head back to the outlook here, you can see the latest value of the housing report. The total value of homes in the UK is 10.5 trillion. That is a huge amount. But the key to this is actually circa 1.6 trillion of mortgage value. So that's quite a small amount in consideration of the fact that they're worth 10.5 trillion. So even if they did have these high mortgage rates continuing, even if we thought they were going to be 6.5, 7, which they're not, but if they did, well, actually, there's only a small amount that's actually under mortgage anyway. So that's why we think the UK market is still strong. That's why we feel that the UK market is still going to be a great place to invest over the next decade. So without doubt, guys, speak to a broker, speak to an advisor, see what we can do for you, and here's to the future. Take care. I look forward to speaking to you soon. Take care. Bye-bye.